Welcome to the Unit 9 Investments vocabulary. So this is vocabulary that's for the stock market. Investments, you invest in stocks, so the stock market. Your first term is ROI, or return on investment. Return on investment is defined as the amount of profit before taxes and after depreciation from an investment. Your next term is investment. So what the heck is an investment? It's the investing of money in order to gain profitable returns. Stocks or shares. The shares representing ownership of a particular company or corporation. Bonds. Bonds are pretty secure if you decide to invest in them. Basically, bonds are a certificate of debt that is issued by a government or corporation, like a bank or an investment company, guaranteeing payment of the original investment plus interest by a specified future date. Now, the thing with bonds to keep in mind is the reason they are so safe, they are so secure, is because they have a very low rate of return, 2.3% or something around that area, versus the stock market, which averages between 10 and 12%. So 3 to 4% or 10 to 12%. So with the greater possible reward comes the greater risk. So there's very low risk with bonds, but there's also very low reward. Mutual funds. Well, an investment company that issues shares and is obligated to repurchase them from shareholders on demand. So the investment company is who buys the shares back, not the market out at Wall Street. Long-term goals. Long-term goals are a gain or loss earned from a sale of a stock held for more than a specified time. Typically, short-term goals are anywhere from 0 years up to 3 years, typically being between 1 and 3 years. And long-term goals are 5 years and beyond. So in this regards, long-term goals, you're looking for either a gain or a loss in the future, way in the future. Now, there are these things called the futures market, which is where it's more of a gamble. As far as how does this all work, most people who are not in the stock market think the stock market is risky. Those who are in the stock market think that futures and options is risky. So if people are looking to have a loss, they're putting a bet on that in the future at some specific date, the market will be down as compared to when they bought in. And these are usually called futures and options. So long-term goals is hopefully a gain earned from the sale of a stock held for more than a specified time. That's what most people are investing in the stock market for. There are things called 401ks and IRAs that are long-term goal-oriented. They are for retirement. And so you're hoping that if you put $100 in today, in 40, 50 years, what you take out will be, I'll just say, $100,000. Those are not real numbers. I'm just throwing that out there. Retirement. Payment from a corporation once an investment matures is exchanged or repurchased. So it's not when an individual retires from a company, it's when the investment matures, is exchanged, or is repurchased. IRA. Do you remember what IRA is defined as from the Kahoot game? IRA is an individual retirement account. It's basically a savings plan that offers tax advantages to an individual to set aside money for retirement. So typically you pay for this with your pre-tax money. So it comes out of your gross income before taxes. Therefore, theoretically, if you're making, we'll just say $100,000 now, when you go to retire, your income will drop from $100,000 to, we'll just say, $50,000. And so now when you start pulling money out of your IRA, out of your individual retirement account, your income level is dropped. Therefore, you're paying less money, less taxes on that money you're taking out than if you had taken it out while you were still making more money. So there's a lot of advantage to pre-tax, having investments come out in pre-tax money. There are all sorts of IRAs. So there's the IRA, there's the SEP IRA, there's the Roth IRA, there's the Keogh, there's a bunch of them out there. Just know that an IRA is an individual retirement account. Inflation. Is inflation good or bad? Inflation is defined as a rise in the general level of prices. So in general, this is bad. This is when a loaf of bread goes from costing $1 to $5 for a loaf of bread. When you go from paying $2 for a gallon of gas to paying $5 for a gallon of gas. It's a general rise in all level of goods that you're purchasing, a general level of prices. So inflation, bad. An IPO. Do you remember the definition of an IPO from the Kahoot game? IPO stands for Initial Public Offering. It's a company's first sale of stock to the public, and it's often issued by smaller, younger companies seeking the capital to expand. In the business world, capital is what they refer to as money. So when, I'll just go back a number of years, Facebook, it used to be a privately held company. And the day that they went, it's called going public, they went to Wall Street and they got to ring the bell and all that. But it was the first time that their shares were offered for sale to the public. Many times you can get shares of a company relatively cheap compared to, say, 6 months to 3 years down the road. So Google may have started selling at, I'll just say, $25 a share. Now, if you try to buy Google, it's something like $1,000 per share. So Google would have been a good one to get in on in the beginning at their IPO. All right, next one. Next one is market. And I don't mean like Kenny's Market, Jane's Market. That's not what we're talking about here. We're talking about the stock market. Okay, so when people talk about the market, they're usually referring to the stock market, which is the market for trading equities. Equities are things that have value. Again, you might hear somebody say the market went down today. What they're referring to is that the value of the stock market dropped that day. So one day it might be worth 19,000, and then the next day it's worth 18,500 in volume. So the market is down. Or you might hear the market is up, and that would be a good day. So in the US, we have a number of different markets. We have the Dow, or the DJIA, which is the Dow Jones Industrial Average. We have the NASDAQ, and that's typically what the technology stocks are traded on. Not always, but typically tech companies are traded on the NASDAQ. There's the S&P, the Standard & Poor's, and they've got a number of them, the S&P 500, the S&P 100, and so forth. There's the Russell 2000 Index, as well as NYSE, the New York Stock Exchange. When people typically think of the stock market, they think of the New York Stock Exchange. And we'll look at a movie next week that explains kind of how the whole stock market works. But there will be a movie or a building with these columns out front. And that is what the actual building that the New York Stock Exchange is in New York City, literally on Wall Street. Okay, an investor. What the heck is an investor? An investor basically is the owner of an asset. Again, an asset is also something that is worth value. And we have two different kinds of markets. So the first market is called a bear market. And a bear market is any market in which prices exhibit a declining trend for a prolonged period, usually falling by 20% or more. That's a bear market. It's going down. Therefore, our bear investor is an investor who believes that a stock or the overall market will decline, will go down. A bear market is a prolonged period of falling stock prices, usually falling by 20% or more. Our second kind of market is a bull market. So a bull market is defined as any market in which prices are in an upward trend. Our second type of investor is the bull investor. And the bull investor is any investor who thinks that the market will rise, will go up. And an asset is any possession that has value in an exchange. So we've talked about two kinds of markets, the bull and the bear, and we've talked about two kinds of investors, a bull investor and a bear investor. There is a third investor, and I'll tell you that in a second. As far as a bear investor, when I was little, my grandfather used to work on Wall Street. Basically, he worked for Shearson Lehman, which was, at the time, it was one of the largest investment companies in New York City. And so he would talk to the grandkids, us grandkids, in simplistic ways, in ways that would help us remember. So these two methods that I have that I'm going to share with you on remembering what a bull versus a bear is come from this. So a bear investor, if you're out walking in the woods and you happen upon 3 little bear cubs, they're typically not alone. Mama bear is there and she notices you. And so to scare you away, the first thing she's going to do is stand up. Now she's going to be much taller than you, 9 feet tall, I'm going to just say. And if that doesn't get you to run, the next thing she's going to do is she's going to extend her hands way up above her head. And if you still don't move to get you away from her baby, she's going to swipe down at you. So Mama Bear is swiping down at you. A bear investor is somebody who believes that the stock or the overall stock market will go down, will decline. Mama Bear is knocking that stock down. So a bull market, again, is where the market is trending upward. Therefore, a bull investor is an investor who thinks that the market will rise. Okay, now I want you to think about, in Spain, they have bullfights. And on one end of the ring, there's a matador dressed in his lovely matador outfits. And he's got the red cape and he's flapping it off to one side. At the far end of the arena is the bull. And he's mad and he's got his head down and he's snorting and he's pawing at the ground and he's just angry and he can see this red cape flapping way out there. And so he starts to charge towards the matador and he's getting closer and closer. And right before he gets to the matador, what does the bull do with his head? He lifts it up. So a bull investor is one who thinks the market will go up. So the bull is running towards you with his head down and then it goes up. The market is going to go up. So the bull investor thinks, versus Mama Bear is knocking the market down, or an investor who thinks the market will go down. So again, there are 3 types of investors. We have a bull investor, a bear investor, and the pigs. Don't be a pig. Those are the people that lose lots of money, who think that they can make it big, who think that penny stocks are the way to go, and they lose their shirts. Don't be a pig. So that is your vocabulary for the stock market.